Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to do a deep dive into the FHA loans. We're going to look at some of the pros and the cons. In other words, we're going to look at some of the reasons why an FHA loan might be really good, and then we'll look at some of the reasons why someone may not want to use an FHA loan. So if you stick with me, by the end of this video, you will have a really good idea on how these loans work and whether or not it will be a good fit for yourself. So without further ado, if you could smash that like button, just give it a little click and hit that subscribe button if you'd like to see more videos just like this. Let's get right to it. All right, so let's jump right into the benefits of using an FHA loan. We're gonna start with the pros. So pro number one is that they are easier loans to qualify for. And I'm gonna walk you through the reasons for that here now. So the first one is that they require a lower down payment than conventional loans in many cases. So with FHA, you can put as little as 3.5% down. In addition to that, FHA loans have much more lenient credit score requirements than their conventional counterparts. And if you look here up on the screen, you can see that with a 580 credit score or higher, you can do as little as 3.5% down, or with a 580 credit score or lower, you can actually do 10% down. Now with an FHA loan, the minimum FICO score requirement is going to be 500. So between 500 and 580, you're going to be required to put that 10% down. But in most cases, folks that are using these FHA loans fall into the first bucket. They're going to have a credit score of 580 or higher, and they're looking to put 3.5% down. That is the minimum requirement. Now, in addition to the lower down payment and the more lenient credit score requirements, the debt to income ratios required for an FHA loan are going to be a little bit lighter than their conventional loan counterparts as well. So DTI, or the debt to income ratio, is basically the sum of all monthly debts, obligations that show up on your credit report, including your subject property, and that's divided by your gross monthly income. If you are not familiar what DTI is or how to calculate it, I'll go ahead and link to a video I did explaining that here below. But for FHA, they will actually allow you to use 31% of your income towards housing, as you can see here up on the screen, and then you can use 43% of your total income towards housing and other expenses. In other words, total debt ratios have to be 43% or less. Now, even though this is what the FHA guidelines state, there is some leniency here. In fact, in many cases, I've seen the debt to income ratios as high as 50% of gross monthly income, but it's based on what we call an automated underwriting approval. So if a mortgage professional runs your particular scenario through their automated underwriting system, and let's say you have some sort of compensating factors would be things like maybe you have really great credit, or maybe you have extra reserves in the bank, something that strengthens your overall credit profile. As a result, the automated underwriting system sees less risk in lending you the money with that specific product, and they will actually allow a higher debt to income ratio. In many cases, a conventional loan might cap at, let's say, 45 or 47%. It's a little tighter, but an FHA loan, as long as you get that automated underwriting approval, you can get debt to income ratios far higher than what their actual guidelines say. Now, the last thing that I wanted to touch on with regards to being slightly easier to qualify for is that the down payment can actually be gifted from a family member. So you can actually get into a property with an FHA loan and use 100% gift funds. Now, a conventional loan may require you to have some level of contribution, whereas an FHA loan, if let's say you had a parent or a relative that was willing to gift you 100% of the down payment and closing costs to get into that property, FHA will allow that. So it's a really good benefit if you're just starting out or you're buying your first home. This type of mortgage product will allow you to get involved in the market. All right, the second pro or benefit of using an FHA loan is that they have lower mortgage insurance rates in many cases. So to provide some context, the way mortgage insurance works is that if you put anything less than 20% down on a property, you're required to carry mortgage insurance in some way, shape, or form, whether it's a conventional loan or an FHA loan. But what happens is the smaller the down payment, the higher the mortgage insurance rates are typically. So the benefit of using an FHA loan is that regardless of down payment, regardless of income, regardless of credit score, the FHA monthly mortgage insurance is going to be a flat rate no matter what. Now there is a little bit of nuance to that, but if you take a look here up on the screen, most borrowers that fall into the camp of a 580 credit score or higher, they're looking to put 3.5% down, and they're not using a jumbo FHA loan, then they're going to fall into the category of having a 0.85% annual mortgage insurance premium that's paid on a monthly basis. So if I can bring your attention to the screen here, if you have less than a $625,500 loan amount and you have a loan to value that is greater than 95%, in other words, you put the 3.5% down, then your annual mortgage insurance premium is going to be 0.85%. Now, if we just pull out a quick calculator here and you take a look on the screen, let's go ahead and say that your loan amount is $300,000. You would multiply that by 0.85%. That's the annual amount you would pay would be $2,550. And if you divide that by 12, that gives you a number of $212.50 per month. So that would be the monthly mortgage insurance premium that you'd be required to pay. Now with a 3.5% down payment, this is actually a very good rate. The exception to this would be if your credit score was really, really good. If your credit score was, let's say, 740 or higher, then a conventional loan may be a better route because you would have discounted mortgage insurance premiums. Let's say you fall into the camp of having a credit score somewhere between 700 or 720, or maybe even you have a score lower than 700, then that annual premium that we see it here up on the screen that you can get through the FHA will most likely be less expensive than if you used a conventional loan. All right, and that brings me to the third pro of using an FHA loan, which is they're not specifically reserved for single-family residences. You can actually use an FHA loan on 1 to 4 units. So in other words, you could purchase a single-family home, but you're also able to purchase a duplex, a triplex, or a fourplex. And there's two things that are really cool about using an FHA loan for those purposes. Let's say you are purchasing a duplex, a triplex, or a fourplex. You're still able to put 3.5% down because the down payment and credit score requirements do not change. In addition to that, you can also use the rental income from those additional units to help you qualify for the loan. All right, and the last pro that I'm going to mention is actually a bonus benefit that not a lot of people think about, but it works really well with FHA loans. So because of the way these loans are structured, both on the rate side and the pricing side, you can work with your lender to get what they call rebate pricing. And what that means is that you take a slightly higher than market interest rate, but in exchange for that, the lender provides a credit which can be used to offset some of the closing costs in the transaction. So let me give you an example. Let's say the current market rate on an FHA loan is 3.5%. Well, instead of securing the rate at 3.5%, if you were to look at taking a rate at 3.875 or even 4%, there may be enough margin in that loan to get what we call a rebate or a lender credit. That lender credit can be used to offset some, if not all, of the closing costs in that transaction. So the beauty of this is that with an FHA loan, you're required to put the 3.5% down, which can be gifted from a family member. However, you're still going to be required to cover closing costs that are involved in that transaction. In many cases, depending on the market you're in, they're probably going to be somewhere from 2 to 3% of the purchase price. So let's say they're 2%, but if you take that slightly higher interest rate, you can get a 2% lender credit. That lender credit can cover those costs, and then all you're concerned with is your down payment. And if that's being gifted to you, you can effectively get into a property with zero money down. So another huge benefit of an FHA loan. All right, so now that we have looked at some of the pros of using an FHA loan, let's take a look at some of the cons here. All right, so the first con has to do with occupancy. This property that you're purchasing, it has to be an owner-occupied home. You cannot buy an investment property using FHA financing. You have to intend to occupy the property as a primary residence, and the rule is you're supposed to be there at least 1 year. But you can, in fact, convert that home into an investment down the road. So this product is specifically reserved for those who are looking to occupy the property as a primary residence, but it's one of those types of products that will allow you to get into a home, and then over time, after you've been there a year, if you decide to move out and turn it into a rental, that's absolutely acceptable. All right, and the second con that we want to talk about here is that you can only have one FHA loan at a time. Now, there is a little bit of nuance. I believe if you move out of state, you can secure another FHA loan, but speak to a mortgage professional about that. For most people, they're going to probably stay within the exact same state, and if that's the case, you can only have one FHA loan. Now, If you wanted to, let's say, turn that property into a rental and then purchase another home using the 3.5% down FHA loan, what you could potentially investigate or look into is refinancing that existing home while you still live there. And in order to do that, you would want to go from the FHA loan over to a conventional loan, and ideally you'd want to be able to improve the rate and or the terms of the existing mortgage so that it makes financial sense before you just free up that FHA loan to go do it again. So anyway, consult a mortgage professional on that, but in most cases you can only have one FHA loan at a time. Now, the third con that we'll go ahead and talk about here today is one that I actually mentioned in the pro section as well, which is the mortgage insurance. Now, even though in many cases the mortgage insurance rate is lower on an FHA loan, there is some nuance. Mortgage insurance on an FHA loan is broken into two different categories. First, you have a monthly mortgage insurance, and then you have a required upfront mortgage insurance premium that is required on every single transaction. And it is 1.7% of the base loan amount. Now that can be financed, it doesn't have to be paid out of pocket, but it actually adds up to quite a bit depending on your actual loan size. So we'll talk about that here in just a second, but if I can direct your attention to the matrix I have up on the screen, for most folks that have a 580 credit score or higher and they're putting 3.5% down, the downside to the monthly mortgage insurance is that it is lifetime. It lasts the entire loan term. In other words, it never goes away. Whereas on a conventional loan, eventually that mortgage insurance is going to drop off. But that is one of the downsides of the monthly mortgage insurance that you'll pay on an FHA loan. Maybe a little bit lower, but in most cases, it will never fall off. Now, regarding the upfront mortgage insurance premium, as I mentioned, that's going to be required on every transaction. It's 1.75% of the base loan amount. So the way that works, if I pull out the calculator here, if you have a $300,000 loan, you would multiply that by 1.75%. And that's a $5,250 fee that essentially has to get financed into that property. So your total loan amount after financing that upfront mortgage insurance premium that's required is actually going to be $305,250. So this is something to be aware of. It's an added fee. It's an added cost involved in the loan. It's going to bring up your annual percentage rate indirectly because of the costs associated with that transaction. That, in my opinion, is one of the downsides of these loans, is that the costs are a little bit higher when you factor in that upfront fee. Now, the last con that I want to mention is that FHA loans have something called minimum property standard requirements. Now, these are not necessarily a bad thing, but they can hang up a deal. Now, let me explain what this is. So up on the screen, I have a little quick article from Investopedia, and it talks about the actual loan requirements and the minimum property standard requirements. So homes financed with FHA loans must meet safety, security, and soundness standards, which includes areas like roofs, electrical, water heaters, property access, among others. Now, FHA does not require repair of cosmetic or minor defects, deferred maintenance, and normal wear if they do not affect the safety, security, or soundness of the home. So on the surface, you think about this and you're like, okay, this is not a bad thing. A lot of first-time home buyers who maybe don't have a ton of cash in the bank to cover or handle some of these things, then this is a good thing that they have these minimum property standard requirements. And in most cases, I would agree. The challenge becomes is that when you're in a competitive market and the listing agent or the sellers understand this and you're writing an offer using an FHA loan, they understand that if the appraiser calls out specific items, they can make that appraisal or that value subject to certain repairs that they call out in that report. In other words, if you have a fence that's leaning or an electrical panel that's exposed, or let's say electrical cover plates that are missing, or the attic, or there's no access to the attic, the appraiser can actually call out these items. And the downside is that the buyer cannot pay to repair those. So you have to go back to the seller, you have to renegotiate and get their buy-in on fixing those items so that you can have the appraiser come back out, re-inspect it, check all the boxes to make sure it meets the minimum property standard requirements before that deal will be able to move forward. All right, so that is going to do it for today's video. We did a deep dive on the FHA loans. We looked at the pros and the cons. What do you guys think about this mortgage product? Do you like it? Have you used it? What's your experience with it? I would love to hear from you. Leave your comments below. And if you haven't done so already, please consider hitting that like button. Just give it a little click and subscribing for more videos just like this. Thank you so much for taking the time to watch this video. Have a great day.